If you want to know where the next Palantir type outcome can come from, you have to stop confusing stock action with business progress. Those are not the same thing. The market loves to throw a costume party every earnings season. One company goes up and people think the future got better. Another stock gets hit and people act like the business suddenly broke. But when you have done this long enough, you learn a lesson that never gets old. The tape is loud. The income statement is usually quieter. And over time, the quieter thing wins. That is the mother line. The biggest money is not made by reacting to who got cheered or booed in one after-horror session. It is made by recognizing which businesses are actually widening their economic power, while the crowd is still trapped inside the noise. That is what this source document is really about. On the surface, it looks like a busy earnings day recap, Meta, Amazon, Google, Microsoft, Cheesecake Factory, AMD, and then one growth stock the author thinks can become the next Palantir. Fine. But the deeper structure is more valuable than that. What the piece is really showing you is a split that matters enormously in this market. There are companies spending heavily and hoping the spend eventually turns into a bigger moat. There are companies supplying that spend and getting rich right now. And then there are businesses the market still treats like a trade, even though they are quietly turning into something much larger. That last category is where fortunes often begin. Let me start with the obvious layer first. Meta, Amazon, Google, and Microsoft all tell the same broad story, but not with the same quality. Capital spending is exploding. AI infrastructure spending is exploding. Revenue is still strong, but the market is no longer satisfied with growth alone. It wants to know which companies are controlling the relationship between growth and cost and which ones are letting cost run wild. That distinction is critical because once a company enters an arms race, shareholders need more than a dream. They need evidence. That is the first mechanism I want you to understand. I call it the expense reality test. When a business is spending aggressively, there are only two acceptable outcomes. Either the spending is already translating into accelerating revenue in the key line items that matter most, or management can show a very clear path to why this spending has to exist and what it will earn for owners later. If they cannot do one of those two things, then capex turns from strategy into a question mark. That is exactly why Meta's quarter feels so different from the others. Revenue was strong. No serious person should deny that. But when cost of revenue rises faster than revenue, when research spending rises much faster than revenue, when total expenses begin pressing so hard that operating leverage weakens instead of strengthens, then what the market hears is not only ambition, it hears slippage. And slippage is dangerous when investors are already being asked to trust gigantic spending plans years into the future. That is why I do not think the real problem with Meta is that Zuckerberg is spending. The problem is that the market can no longer clearly see how much of that spending is necessity and how much of it is excess. That is a very uncomfortable place for a stock to live because if management cannot clearly justify the incremental dollar, the stock itself often becomes the mechanism that eventually forces discipline. That is how these things work. You do not usually get restraint before pain. You usually get pain and then restraint. Now compare that to Amazon and Google. Both are spending huge numbers. Numbers that would have sounded insane just a few years ago, but the market is much more willing to tolerate it because the evidence is easier to see. AWS growth accelerating, Google Cloud growth exploding, advertising strength, operating leverage still holding together. In other words, capital goes in and a specific engine inside the company clearly spits out more power. That is a completely different story. This is the second mechanism. I call it visible output. Markets are surprisingly generous when they can identify where the money is going and what that money is doing. Amazon can spend aggressively because AWS is clearly becoming even more important. Google can spend aggressively because cloud is no longer just a side story. It is becoming a real second power center. Even Microsoft, though less explosive in this set of numbers, still has enough structural authority in the market that heavy spending can be forgiven if the operating machine remains disciplined. This is why I always tell people not to look only at the headline number. $100 billion of spend means nothing by itself. Where it goes matters. What it produces matters. Whether it creates leverage or destroys leverage matters. That is the adult version of earnings analysis. Now here is where the source document becomes much more interesting to me, because all this hyperscaler spending is doing something else at the same time. It is feeding the companies selling the shovels. That is the third mechanism. I call it the supplier siphon when Meta, Amazon, Google, and Microsoft all decide they must spend more to remain competitive. That money does not disappear into the clouds. It lands somewhere: chips, memory, compute, infrastructure. The businesses on the receiving end of that spend often have a much cleaner short-term setup than the businesses doing the spending. That is why I think the source is directionally correct when it says names like Nvidia, AMD, and Micron may have the cleaner next 12 to 18 months than some of the mega caps themselves. Those firms are not being asked to explain why they spent so much. They are being paid because everyone else has already decided they must. That is a beautiful position. A toll road does not need to justify the race. It just collects this matters, because many investors still think the best place to stand is always inside the most famous platform company. Sometimes it is, but sometimes the better risk-reward sits inside the company feeding the platform arms race. That is a more profitable place than most people realize. Now let us move to the real opportunity in this source document, because the whole first half is really just stage setting for the final reveal. The market's biggest mistake is not always overpaying for excitement. Sometimes the bigger mistake is underpricing the company that is quietly becoming structurally stronger, because the crowd still thinks it is just another story stock. That is where SoFi enters. And that is why this is not simply a stock that got hit after earnings. It is a business that may be getting misunderstood at a very important stage of its life. That is the fourth mechanism. I call it the identity lag. The market often values a company based on what it used to be long after the business has started becoming something else. That lag creates opportunity. SoFi is still treated by many people like a speculative fintech name that has to prove it belongs. But the numbers in this source document tell a much more powerful story than that. Net revenue up 43%, net interest income up 39%, non-interest income up 49%, income before income taxes up 150%, net income up 135%, EPS doubled, members grew to 14.7 million from 10.9 million, platform accounts, which had been slipping, turned back higher. That is not the profile of a company losing control. That is the profile of a company becoming more dangerous. And I use that word very deliberately because the most important part of a story like SoFi is not just growth, it is direction. Where is the business heading if management keeps executing? Is it becoming narrower or broader? Is it becoming more dependent on one niche or less? Is it becoming weaker as it grows or stronger as it grows? What I see in these numbers is a company trying to evolve from product seller into financial operating system. That is where the next Palantir type re-rating often begins, not in the moment the market falls in love. In the phase when the business is broadening faster than the market is updating its identity. That is why I think the source document's comparison matters, even if it sounds dramatic. A next Palantir does not mean the same sector, the same product, or the same chart shape. It means a company that still feels controversial or uncertain to the public, while the underlying machine is actually becoming much stronger than consensus has admitted yet. That is the kind of setup that can produce extraordinary returns. Now let me be balanced because I do not want to turn this into religion. There is real risk here. This is not a software business with no balance sheet exposure. This is not some light little app with infinite margins. SoFi lives in and around banking, lending, credit, and financial services. That means the market will always apply a different kind of skepticism, and not without reason. Any company in the financial arena can get itself into trouble if underwriting weakens, if the macro cycle turns ugly enough, or if management gets too confident and stretches risk further than it should. That is real. You cannot ignore it. This is the fifth mechanism. I call it the balance sheet shadow. The faster a financial company grows, the more people should ask what kind of growth it is. Is it growth produced by skill, distribution, product expansion, and customer acquisition, or is it growth produced by taking more hidden balance sheet risk than the market fully appreciates? That question must always be asked, but the answer does not have to be pessimistic. Sometimes the reason a company deserves a premium is precisely because it is finding ways to grow faster while keeping the model more capital light, more fee-oriented, and more ecosystem-driven than the incumbents it is attacking. That is where SoFi becomes interesting, because if it keeps expanding beyond loans into broader financial relationships, then the market may eventually stop valuing it like a niche lender and start valuing it more like a platform. And platform multiples are very different from lender multiples. That is the sixth mechanism. I call it the relationship flywheel. The most powerful businesses in finance do not win because they sell one product once. They win because once a customer enters the system, the company keeps finding more ways to become useful. Banking, credit, brokerage, payments, savings, personal finance, crypto, advice, platform services. The more functions a company can credibly combine without destroying the user experience or the economics, the more it moves from vendor to ecosystem. That shift matters enormously, because ecosystems are harder to leave. Ecosystems are easier to monetize. Ecosystems create more durable customer economics, and ecosystems tend to deserve higher valuations than isolated products. This is why I do not care much when a stock like SoFi gets hit on one earnings day if the business underneath it is still getting broader and stronger. The tape can hate it today. The tape is not the owner. I am more interested in what the company can be in 5 years. And here is where I think the source document is aiming at something very real. When the writer says $50 in 5 years and maybe 100 plus long term, what he is really saying is not this quarter was nice. He is saying the company is still early in the process of becoming much larger than the market's current imagination of it. That is the seventh mechanism. I call it the imagination gap. Every great winner spends time living inside a period where the numbers are improving faster than the market's imagination is expanding. That gap is where the money gets made. Once the imagination fully catches up, you can still make money, but the asymmetry narrows. Before it catches up, the stock can look messy, misunderstood, and frustrating even while the business is strengthening underneath. That is why I have always preferred looking for widening gap situations. Not just good companies where the future shape of the business is still being underestimated. That is a much more valuable hunt. Now let us come back to Palantir one last time, because that comparison is not really about comparing product to product. It is about the emotional path of the stock. Palantir spent years in a place where people argued about it constantly. Too expensive, too weird, too dependent on this or that, too much stock compensation, too much noise, too unclear. And while that was happening, the people who stayed close enough to the business could see that one thing mattered above all. The machine kept getting stronger. That is the only thing that matters in the end. Not whether the market liked the quarter, not whether social media was impressed, not whether the stock got punished for a week, whether the machine is getting stronger. That is the question I would ask of SoFi now. And my answer, based on the source document S numbers, is yes, with risk. Yes, with volatility. Yes, with balance sheet complexity. Yes, but still yes. And that is enough to keep my attention. So here is where I come down. Meta may be entering a period where the spend story gets uglier before it gets cleaner. Amazon and Google are proving that giant capex can still be tolerated when the output is visible enough. The chip sellers may still have the cleaner short-term setup because everyone else is funding their next leg. Cheesecake remains a beautiful example of a simple cash-generating machine the market still underappreciates. And SoFi, to me, is the one name in this source document where the long-term asymmetry may be the most interesting. Not because it is the least risky, because it may be the least fully understood. That is where I like to look, because in markets, the most profitable opportunities are usually not where the crowd already feels smartest. They are where the business is becoming obvious before the stock is. That is what a next Palantir type setup really is. Not a stock everyone agrees on, a stock the market still thinks it understands. Right before it has to admit the company became much bigger than the old label it had lazily assigned to it.